The silent erosion of wealth is a critical economic challenge many individuals overlook. Your money, while seemingly stable in a bank account, is constantly losing value. This phenomenon, known as inflation, subtly diminishes your purchasing power over time. It means that the same amount of money today will acquire fewer goods and services in the future. Inflation is defined as a persistent increase in the general price level of goods and services within an economy. Economists measure this increase using price indexes like the Consumer Price Index, or CPI, which tracks the average change in prices paid by consumers for a basket of everyday goods and services. A common target inflation rate for healthy economies is around 2% annually. The primary causes of inflation are broadly categorized into demand pull and cost push factors. Demand pull inflation occurs when aggregate demand for goods and services outstrips the economy's ability to produce them, often driven by increased consumer spending or lower borrowing costs. Conversely, cost push inflation arises from increased production expenses, such as higher raw material costs or wages, which businesses then pass on to consumers through elevated prices. This continuous rise in prices has a direct and detrimental effect on purchasing power. As inflation increases, the real value of money decreases. Consequently, consumers can buy less with the same amount of currency than they could before. This reduction impacts everything from daily expenses to long-term financial stability. Consider the historical impact. During periods of hyperinflation, such as in Germany in 1923 or Zimbabwe in 2008, currency became almost worthless, with prices skyrocketing by astronomical percentages. Even at a moderate 3% annual inflation, an item costing $100 today will cost approximately $134 in a decade, representing a significant decline in real wealth if money remains static. The illusion of security offered by holding cash is particularly vulnerable to inflation. Money kept idle in savings accounts, especially those with low interest rates, loses real value over time because the interest earned often fails to keep pace with rising prices. This means that while the nominal amount in your account may increase due to interest, its actual buying power diminishes. To counteract this persistent erosion, investment becomes not merely an option, but a financial imperative. Investing allows capital to generate returns that can potentially outpace inflation, preserving and growing wealth in real terms. The objective is to achieve a real rate of return, meaning the investment's return after accounting for inflation. A diverse array of investment vehicles can serve this purpose. These include equities, which represent ownership in companies and have historically outpaced inflation over the long term. Other options include bonds, real estate, mutual funds, and exchange-traded funds, each carrying distinct risk and return profiles suitable for different financial goals and time horizons. The mechanism through which investments combat inflation is the generation of returns exceeding the inflation rate. For example, if inflation is 3% and an investment yields 7%, the real return is 4%. This growth offsets the decrease in purchasing power. Consistent investment and compounding returns are crucial for long-term wealth preservation. However, investment inherently involves risk. While some assets offer higher potential returns, they also carry a greater potential for loss. Diversification across different asset classes helps mitigate these risks, balancing potential gains with protection against market volatility. A long-term perspective is essential in investment. Short-term market fluctuations can obscure overall trends, but historical data often demonstrates that diversified portfolios tend to grow over extended periods, providing a more reliable hedge against inflation. The cost of inaction, therefore, can be substantial. Failing to invest means accepting a gradual decline in wealth. This opportunity cost, the potential growth forfeited by not putting capital to work, is a silent but potent destroyer of financial well-being. Understanding these economic dynamics empowers individuals to make informed financial decisions. The objective is to ensure that personal wealth actively grows, rather than passively depreciating under the persistent force of inflation. This strategic approach to financial management is fundamental for maintaining and enhancing economic standing,